Well, if you run a business, there are differences in how you file your taxes, and it depends on what type of business you are. With a little explanation, please say hello to Tom Baltasconis from Jackson Hewitt. Good morning one more time. Yeah. Almost the deadline is coming, right?
Yes, it is.
And are you busy?
Yes.
We joked about how he's pulling his hair out.
I didn't have gray hair before.
Oh, you used to have Justin Bieber hair.
Right. Well, not quite that long.
Right. Let's talk about S corporations and sole proprietorships again. Remind us what they are.
Okay, sole proprietorship is someone who just works for themselves.
Right.
You know, who has you know, the business, and then you keep all the records and things like that. And an S corp is you actually form a different entity. It's an entity on itself, and it becomes its own kind of thing by itself, and then it pays all the bills.
And there are differences in the way, right, that we have to file the taxes or pay. How does that work?
Well, when you have a sole proprietorship, you don't pay yourself. You just take money out of the company, and then it shows up on your tax return as profit, right? Well, you have to pay Social Security and Medicare on both sides, so that's 15%, as opposed to you know, when you work for somebody else, you know, you get a paycheck and it has Social Security and Medicare withholdings. Right. Well, when that company sends the taxes to the IRS, they match your Social Security and Medicare. Well, when you're self-employed, you are the employer, so you got to match that side. So that's 15% just on Social Security and Medicare, and another 15% for your income taxes, assuming you're in the 15% tax bracket.
And most people who run these businesses, they ought to know that stuff going in.
Well, a lot of people the first year, they don't realize that they have to pay that extra Social Security and Medicare because they've never done it before.
And so could that jack up their tax bill?
Yeah, it does. It really does, because you know, you take somebody that has a profit of say $10,000 or something, all of a sudden it's an extra, what, $750, $800 that they're not used to paying before.
Right. Right. Let's talk about personal property and how that makes a difference if you're in an S corp or a sole proprietorship.
Well, the personal property part is, you know, when you're in an S corp, or when you're in an S corp, and say you end up in a lawsuit, the company is suing or whoever's suing the person, they are suing the company. And your personal assets are not involved in the company. Okay. It protects your personal assets, your house, and things like that. Whereas a sole proprietorship, they can actually sue you and get everything you own.
So let me ask you, in terms of an IRS standpoint, if I have a big tax bill, can they put a lien on personal property?
I don't know about that one.
Sorry, we just put you on the spot.
Oh, that's okay. Yeah, it just came to you. Well, normally when you owe taxes, it's not, the corporation doesn't owe any taxes because it all passes through to and that's an S corp. It all passes through to you personally, not paying your taxes. So it's going to go against you and not the corporation.
The deadline is April 18th. Time is running out, but if you need some help with Tom, you can find more about Jackson Hewitt on our website, coloradoconnection.com. Good luck to you the next couple of days.
Yeah, we'll be busy.
It's going to be busy. We'll see you around.